Most business owners are structured wrong and it's costing them thousands of dollars every single year. Let's walk through a case study, LLC versus S-Corp, just so you could see how powerful the right entity structure could be. So let's start with the business itself. Let's say same business, either entity, you make $300,000 in gross revenues. It costs you about $150,000 to carry out the activities of the business to run operations. And at the end of the day, you're left with what? $150,000 in net income. Now, at the end of the day, the income tax is going to be the same, but the self-employment tax is going to be applied on that entire $150,000 bottom line. If you are just an LLC with no S election, it is going to default to 15.3% applied to that $150,000, which equates to almost $23,000 in self-employment tax. Now, had our taxpayer business owner been smart and made an S election, and had they been taxed as an S corporation, they could have taken advantage of the W2K1 split, essentially breaking up that bottom line into two different pieces, one through payroll on a W2, and then the rest coming through on a K1 as a distribution. Now, that distribution is not subject to self-employment tax, only the W2 amount. So only 15.3% is going to get taxed on that $50,000, which is about 7,600 bucks. In other words, had our taxpayer been an S Corp this entire time rather than just filing on Schedule C, they could have saved over $15,000 in self-employment tax alone. And moving forward, that's the standard. You're going to get those savings every single year. So you can see how powerful the correct entity structure is. And this is just one of the most common mistakes we see business owners, new business owners make when it comes to their entity. But there's a lot more tax strategy out there, and this is just scratching the surface.